My name is Nancy Lane. I am the current president of North San Diego County Realtors. And today we have the fantastic privilege of having with us Stephen Thomas, who is a chief economist, and he has a little thing called Reports on Housing, which is your local real estate snapshot. We're just talking about how incredibly important it is to have up-to-date information and how helpful that is to us in our industry. Mr. Thomas has started his Reports on Housing in 2004 as a way to communicate what buyers and sellers and real estate professionals were experiencing in the trenches. That would be us, tracking demand, inventory, distressed homes, and market data at both the county and city levels. Stephen Thomas is a California real estate broker with decades of real estate experience and a degree in quantitative economics and decision sciences, which is a very amazing title. It sounds very important. From the University of California, San Diego, and he developed Reports on Housing and is considered an expert in real estate housing trends. Reports on Housing has been utilized and quoted by the Orange County Register, the LA Times, Wall Street Journal, New York Times, USA Today, Bloomberg, Fortune Magazine, Orange County, and Los Angeles Business Journals, ABC, CBS, and NBC Television, as well as Cox Cable, CNX 1070, KFI AM 640, blogs, and internet news sites, resulting in newspaper, television, and radio appearances. So the guy knows what he's talking about, and he gets quoted by people who know what they're talking about. So that's a pretty sterling endorsement. Besides his passion for real estate, Stephen and his wife TJ are busy raising 9 children. That's not enough to tell you how you can organize. I'm not sure what is. He loves to run long distances, pushing his youngest in a jogger while the older kids cycle beside him. Stephen has served on the Orange County Association of Realtors as a director and has served on the member benefit committee for 4 years. He's amazing. In other words, he knows what he's doing. He knows what he's saying, and he's been there as well in the trenches with us. Everybody, Stephen Thomas.
Thank you so much. I appreciate it. Somebody asked if this is going to be recorded. I think it is, and I am going to go ahead and begin the presentation. I also will provide a copy of this presentation as well, so I'll send it over to Shirley so she can get it out to anybody that would like it. But I'm going to go ahead and get started. I have a lot to cover, but first, of course, I'd like to start off with something fun, winter fun photos, before we get into the nitty-gritty details of economics and what's going on in housing and the world around us. Let's start off with some fun photos. And this is actually an MLS photo. An agent sent this to me. I think this was an afterthought of they're putting in this cabinet, measured it wrong, and shoot, let's just keep it. And they did.
Oh my God, my OCD would go nuts.
Yeah. And I know how hard it is to take a picture of the bathroom, but yes, this is a fail once again, taking a picture of the bathroom and getting themselves in the shot. And I guess they'd call this the cow house. If you look hard enough, there is a problem with the design of this kitchen. I think originally they were going to stick the stove right here in front of the window, and then they moved it, and now there's a bent hood that's out of place. Sold over asking. Funny, not funny. Or if you want something more expensive, I can show you this again tomorrow. Also funny, not funny. Tom Brady has been to more Super Bowls than there are active listings on the MLS right now, especially in San Diego County. I'm going to wait until the market crashes. The market, kind of like Tom Brady, pretty resilient, right? It's going to be around strong for some time. So my background is I'm a quantitative economics decision sciences major from beautiful campus of UC San Diego, 30 years in the business, Orange County native, Capital Valley High School grad, 9 kids, avid runner. These are my kids. I brought the 6 on the right. My wife brought the 2 on the upper left. I adopted hers because we had them all the time, and she adopted mine. And then we had this bonus guy. He turned 3 about 10 days ago. So we're one big happy family, and we have a dog. So like she was mentioning, I have been quoted all over the place, from New York all the way to London, and just talking about Southern California statistics and housing and all that good stuff. Our company's Reports on Housing, your local real estate snapshot. It's about driving home the expectations for buyers and sellers, and it really articulates what we're feeling out in the field and puts it in numbers and data, real sound information. And we don't really focus that much on closed sales data. We do provide it. It's just not something that I like to talk that much about, other than last year, all of a sudden luxury closed sales started to be astronomically high. So, and disproportionate number of sales were luxury. So I had to talk about it. And I did, but normally I don't like to talk that much about closed sales data because it is a reflection of what's happened in the past. I really don't care that much about what happened in November, December pending sales that led to a January close sale. Instead, I want to look out the windshield and talk about supply and demand. The available number of homes to show a buyer that are available today, that's your supply, and demand, which is a snapshot of the last 30 days worth of new escrow activity. And from that, we're able to get the expected market time. And that just tells you the speed of the market. If you place your home on the market today, when are you opening up escrow down the road? So that's what everybody should care about. Sellers, buyers, everybody. We talk about price ranges, the differences between cities, all that stuff. It's all provided within the report. And it's about setting the expectations of everybody, because everybody has an idea what's going on with real estate. And some people think that they're the expert, but they've seen an article maybe on CNBC, or they listened to a video and think that everything's going to implode as far as the wave of foreclosures is concerned. And instead, I rely on data and a powerful economic model, housing model, that I then provide you so that you have the power. So anybody can find whatever they want on the internet, but they can't refute sound data. They just can't. It just doesn't make sense when it can actually back up what's going on with numbers, and that's what we do. And I try to put it, we carve out one story at a time, and we bring this to you. And then there's a little section on inventory, demand, and luxury. And later on down the road, when there's more distress, which there won't be a lot more, we'll talk about distress so that people understand it's not that big of a deal. And we have reports that dot all over Southern California. LA is about to hit their two-year mark in March, and San Diego will hit their 2-year mark in April. I actually have data that goes back to 2012 just for the county, for the macro area. But as far as the nitty gritty, like if you want to look at what's going on in Oceanside, now I'm going to have year over year data, and now I'll have 2-year-old data as well. So you can see how things have evolved and changed. So what the reports have looked like so far this year, actually starting at the middle of December, was lock it in. This still applies today. Values are going up, and so are interest rates. So you need to buy now. I know it's extremely frustrating to be a buyer. Please do not wait for more homes to come on the market. That is just not the smartest strategy. Then at the very beginning of the year, we had a blazing beginning. We had the hottest market from on January 1st. It beat 2013's hot market. And we actually had a hot seller's market where prices were appreciating from January 1st on. Typically, it's right around the Super Bowl that things start to get really hot. But this year, it was starting from day one of January 2021. Started talking about boiling over and how the market is just absolutely, it's almost too hot for comfort. Then we went into bidding war, and I talk about the strategies for sellers for dealing with the bidding war, as well as when buyers read this, they understand why the market is the way it is. And you know what, I'm all about pricing the property according to its fair market value, and then let the auction begin. And then you'll get you'll get a lot more offers and better terms. And if you have a fallout, which I've heard plenty of homes are falling out so close to after replacing them into escrow, you have a whole slew of people to go back to put that thing right back into escrow. No top in sight. This is the most recent one that came out on Tuesday for San Diego. And really, this is that this is not going to top out. The market's not going to change to a buyer's market. We have the legs for this to last for quite some time, and I explain why in this latest report. So go to reportsonhousing.com. That's REPORTS. It's the plural report, reportsonhousing.com. Click on subscribe, and I'll send you out the most recent one that, and at the very bottom, it will email these to you. And at the very bottom, there's a bunch of links. And these links are for printing it out, for copy, cut, edit, paste, add your logo, make it a part of your newsletter. Change around the information if you want to. Excel spreadsheets, as well as an excerpt for public-facing websites, social media, blogs, and a whole bunch of charts that are updated with every report. I only include a couple to 2 or 3 charts in the report, and there's about 20 that we update every single report. This thing comes out every 2 weeks. Today, we're actually just finished. I was actually checking that while everybody was coming on, what the numbers look like for Southern California, but it's San Bernardino and Riverside that comes out this coming up week. So we just finished crunching those numbers. $15 per month or $150 per year. You get a month free if you sign up utilizing the coupon code NORTH. SD, that's you guys. And really, this is about making it inexpensive. So you're thinking, gosh, you know what? Should I go get Starbucks or should I make my own coffee, which we all got good at during this pandemic? But you know what? And instead, get this housing report, which will help make me more money. And this is what I hear from so many agents, that they use it for price reductions, for listing presentations, for getting buyers off the fence and into escrow. It's that's what it's all about. And by the way, I was represented buyers and sellers from 1991 till 2003, which is where I came up with all the statistics to show my buyers. Then I hung up my hat and got into running a brokerage, and my sister and brother-in-law took over my business. And then I got into this, where this is my only gig now, and totally enjoy bringing everybody the cold, hard facts so that we can educate everybody so they can make proper decisions and have the best expectations for pay dirt. But let's talk about the overall economy. And the GDP last year was negative for the year. The first quarter was negative. The second quarter was wildly negative. It was the worst quarter in United States history, followed by the best quarter, and that was the third quarter of 2020. And then the fourth quarter was slightly up again. And this shows you how it was very V-shaped, but then it started to slow down because we're still dealing with a pandemic. So it will continue to go at this velocity. So we are going to continue to improve, but we won't re-engage with that prior line until the end of this year, start of next year. So, and unemployment, as far as that is concerned, it is, it's been sticky. It's not really dropping like it was before. Unemployment rate right now is at 6.3%. It was at 6.5% for 2 months in a row. Now it's at 6.3%, and it's kind of sticky. It's not going down really fast. And you can see here that you can see on the left where we went into the pandemic in March and April were super negative. But then you can see starting over here that this was November slightly up, December slightly down, January slightly up. You can't even barely see it. So not a lot of change right now. It's not until we're totally vaccinated that we're gonna see this real thawing out. Although I'm thinking that we're gonna see this a little bit faster than what people are projecting, and it will be a pleasant surprise. But with it still being a pandemic, you could see that the jobless, the people that are employed, there's about 10 million that are missing, and these will all start to come back. But the ones that are having the biggest problems are travel and entertainment, and those are going to take still a little bit longer until we're fully vaccinated before we start to see those totally come back. And the apparel industry has been hit pretty hard as well. So this is something for us to watch. When will America be back? What am I looking for as an economist? COVID-19. And I'm watching that closely, because as COVID-19 plays out, that's the way the economy works. Unemployment is something I'm watching, and hard hit industries. I went into all those, but unemployment and hard hit industries have a lot to do with COVID-19. Core retail sales are actually doing spectacular. Manufacturing is doing great. We don't even have enough jobs. There are jobs to be had in the manufacturing. They can't find enough workers right now. New home sales, they're off the charts, and consumption is fine. You can see this is one of the charts. This came out last week. Retail sales beat expectations after a really slow December. It was just off the charts also. It was incredibly good. So that led to a lot of optimism in Wall Street. And like I said, the path of the economy will depend significantly on the course of the virus. That's what the Federal Reserve said. So that's why economists follow COVID. It really makes sense for us to follow it so that we understand it, where are the numbers going, so that we can see where do we project that things will be as people go back to some semblance of a normal life again. So, and there's still this COVID-19 that's out there. We've had the first, the second wave, and the wintertime was really bad. We just don't want to have any more waves. We need to get ahead of this thing. There's still a virus that is out there. There's a really contagious version that's out there. Yet I see a lot of people, at least in my neck of the woods, that just are not masking up. I'm still being incredibly mindful because I'm an economist and I watch the numbers, and I'm very hopeful that the COVID-19 vaccine, now that there are 3, and there's going to be a third one, Johnson & Johnson, in the marketplace very shortly. They got emergency approval. So things are looking better. And as far as people getting injections in their arms, 91,700,000 doses have been delivered, and 68.3 million have gone into the arms of various citizens. So that's 21%. So we're right now hitting about 30% of the population is inoculated from COVID. And why do I say 30%? Because in the United States, 8.8% have had COVID. They're not the ones that get the shots. They will be later on down the road. They still need to get the shots, but they're last. So about 30% of the population now is immune to COVID. So that's pretty strong. Right now, the last 7 days, we're adding 73,000 per day for the last 7 days. It's kind of sticky right now at the 73,000 mark. It's kind of stayed there, which is very close to where we were peaking out during the summertime. And as far as California is concerned, 9% of all Californians have had COVID. I like to put these in numbers that people understand rather than this so many million. How about this? Almost 1 in 10 people have had COVID-19. And I'm sure the people it's underreported. So I'm sure it is 1 out of every 10 people have had COVID at this point. We're averaging 6,000 cases for the last 7 days. If you draw a line across, that's well below where our summer peak was here in California. So we're on the right path right now. It looks really, really good. I'm very, very happy and optimistic with the direction that California is headed. It's even doing better than the United States right now. So, which means that we're going to unlock things. And San Diego and Orange County remember the days of the red tier. We're going to be going to the red tier pretty quickly, probably within the next few weeks. So that is really good news. And if you look at this, this is strong. This is pretty darn strong. This is where we're at right now. Things are going to open up. All the lights are going to come back on in California. We're going to go to the red. We're even going to get to the orange tier with more people getting vaccinated, which is really awesome. As far as manufacturing, not manufacturing, as far as purchase applications are concerned, I wanted everybody to see this. This is pretty fantastic. Just a second, actually, I have to pick something on my screen. There we go. As far as the mortgage purchase application, these are purchase applications. It has been strong for the past year. It's only up 7% year over year. It's going to get closer and closer to where it was a year ago. And that's because we started to see year over year gains even last year. So these are really strong readings where we're at as far as purchase applications are concerned. And it's 40 weeks straight. Oops, just a second. I'll be back. I have to actually shut my door. I just heard my dog. So I told my dog not to bark, not listening. Anyways, 40 weeks straight of year over year growth, which when we went into the pandemic, we only had 5 weeks of negative year over year growth as far as purchase applications were concerned. It's been 40 weeks straight of 7% plus. So that's pretty fantastic. I just wanted to share that wonderful news. And as far as forbearance is concerned, it's decreased last week from 5.29% to 5.22%. And what does that mean? That means that only 2.6 million people are in forbearance right now. And watch last week's episode. I actually talk about forbearance in detail of my housing debrief that's on Facebook. I'll get into that at the end of this presentation. But you really should watch that because it really talks about how there's not going to be a wave of foreclosures, contrary to what so many people are thinking. Here you go. 2.6 million people are currently in forbearance. That's not that many. So just understand that. And you think that that's a lot. I only want to say one more thing, that 90% of everybody in forbearance has at least 10% equity. So the story really is, if people are still hurt, they can actually sell their homes and dip into their equity in order to sell. So there's not going to be a wave of foreclosures. There will be a rise, just not a wave. We're going to look at more like 2016, 2017 numbers of foreclosures and short sales. So not nearly what some people are anticipating. The only people that are arguing with me right now that are out there, and because I get a lot of people that have counter arguments to what I'm talking about, are the people that work for asset management companies or work short sales during the last downturn. So they have it in their own self-interest to root for it, and they try to look for information that shows that that's the direction that we're going to go. But I can rest on my laurels that that's just not going to happen. And as far as Washington, D.C. is working on this next relief bill that is coming, and it's going to be pretty large. This will be the 5th package that we had. We had one in December. It took us forever to get there. And this will probably be the final package. From there, we'll get different stimulus that will inject into the economy. Maybe the airlines might need one because they've been stalled for such a long time. So I don't know. We'll have to stay tuned for that. But I wanted to talk really briefly about national housing. And national housing has the same problem that we all are experiencing. And in the United States, the year-over-year housing inventory is down 42.6%. And this is across the United States. California is at 36.6%. So it's not just a California problem or a Southern California problem or a San Diego problem. It is across the United States, and it has everything to do with interest rates. And as a result, we're watching on the right-hand side of this, you can see, this is Case-Shiller, that we are spiking in values. We went up 10% year over year in December. That's too strong for what I like. That last happened in 2013, but then it started at the end of 2012 and then went through the start of 2013 and then it peaked in 2013 and started to come down as interest rates rose in 2013. That's going to be very similar to what happens in 2021. And as far as the San Diego County market is concerned, housing is extremely hot. And first-time homebuyer tax credit, I wanted to talk about that really briefly. If you really, really are rooting for this thing, this is where everybody that is a first-time homebuyer gets a $15,000 first-time homebuyer tax credit. They did this during the Great Recession. The problem is during the Great Recession, we didn't have enough demand, and I could actually watch the demand increase. Right now, we do not need to enhance the demand side of the equation. I am totally against the first-time homebuyer tax credit. I would rather see a first-time home seller's tax credit, where it's the first time that they have ever sold their home. That will get things juice. But that's my own take on that. 2021 is very reminiscent of 2013. And 2013 was a very, very hard year to work in real estate, at least for the first 6 months. And that is what we are dealing with today. And why is that? Because sellers are getting greedy. They're getting record prices and they're still thinking, gosh, we had so many offers, I could have got an extra $10,000, $15,000. The problem is we're running into appraisal issues. So you can only get so much, but they still want more because they sell so quickly. And then buyers, if you've got 25 offers that are generated on a house, how many people get it? 1. So that means 24 people have to go back to the drawing board. And that is literally happening in the marketplace, as you know. So, and as I usually say, let's talk about supply and demand, but really at the end of the day, what's causing this disproportionate hot market where we have not enough homes on the market and we have way too much demand, it is way too low of interest rates. And if you want to ask what keeps me up at night, it is the fact that interest rates are too low. At least something is changing. I don't know if you saw that, but interest rates are already bumping up to about 3 1/8 to 3 1/4% just from yesterday, which is much relief from where we were at before. It is actually what I'm rooting for. And you're saying, why are you rooting for this? I am a homeowner. We just can't sustain 10% appreciation year over year or even higher. A, B, we're not going to get more inventory until interest rates actually go up. It will stay really low because what's happening is as things come on, they're flying into escrow. So let's talk about the supply. This is where supply is at right now. On February 18th, exactly 1 week ago, we were at 2,286 for sale homes available in San Diego County. That's nothing. That is literally like an empty tank of gas. And you're wondering if I'm going to get to the gas station. That is how low 2286 is. I can't even believe the size of San Diego County, and it has fewer homes on the market than Orange County. It is atrocious how low your inventory is today. And last year you were at 4,652 at the same time period. And if you remember last year, it was pretty hot during this time of the year. That's double the inventory as to where we are today. So you guys have half the number of homes on the market. Ridiculous, right? Today we're at 2,268. For some reason, you're still going down, and that's just not good at all. So as far as where we were at, this is as of last Thursday. If I draw a line across, holy smokes, we've never been here before. It's the lowest level since tracking began in 2012 for me. It beat 2013, which was the prior low level. As a matter of fact, there's 49% less homes on the market today than 2013. That's just nothing on the market. So right now, you just have to understand, it's really hard to move in this market because there's no inventory, and you've been experiencing that. And really what's happening is we are in the winter market. It's still winter time. I know that it's been really beautiful, like 75 degrees last couple days, but you know what? That doesn't make it spring because it's nice out. We're still experiencing winter. Most homeowners state that they're going to place their home on the market when? Spring. And then second most is actually summer. We are still in winter, which means we're in February. So the supply does not change much. So when they say they're going to place their home on the market, that's not until the second half of next month. And so that tells you what's going to happen with the inventory until we get to the second half of next month. Inventory is going to continue to remain flat or even go down slightly, and then we will start to rise. And then we're going to even rise further. And the reason I think we're going to rise further is because interest rates are going to continue to rise, and it's going to start to soften demand enough. And we're going to get enough homeowners that are going to come on the market and be too overzealous. They will overprice, and they won't get their price, and they'll sit on the market and they'll accumulate. They'll come on the market late and they'll accumulate, and we won't peak until the fall. Typically we peak during the summer months between July and August. And there is nothing on the market right now. I get it. It's not that COVID-19 is suppressing supply. Instead, we're kind of like created this own problem by having too much demand, but there's nothing to buy. We have homeowners that are not placing their homes on the market because there is nothing to purchase right now. San Diego County, if you look at the 5-year average and of the number of homes coming on the market, in December of last year, 2020, just a couple months ago, we actually placed 11% more homes on the market than the 5-year average in San Diego County. That's an extra 241 homes. Then January hit. Not a lot of homes. And then homeowners were saying, I'm not placing my home on the market, I'm gonna wait a little bit. We had 22% fewer homes. That's 940 fewer homes. That's almost 1,000 fewer homes. That's a lot of missing for sale signs that are out there that we could have been placing into escrow that we don't have an opportunity to because of this issue. And I'm here to tell you, I'm starting to look at the February numbers. We're not done with February yet, but I can tell you this much. February looks like it's going to be a repeat for January in the county of San Diego. You guys are not placing enough homes on the market right now. About 1/5 fewer homes are coming on the market right now. So that's a big portion of your market when we have so much demand. But we're going to get to the point later on this year where people are going to have that FOMO, fear of missing out. They're not going to want to miss out at all. So what are they going to do? They're going to place their home on the market, and there's going to be more and more homeowners that come on the market as the year progresses. So understand that that will happen. I just wouldn't wait for it if I was a buyer, because values will be higher then, and so will be interest rates. And across the board, you could see fewer homes in the market compared to last year. Riverside and San Bernardino are actually, that combined metro is the second largest drop in inventory in the United States. San Diego's not that far behind with 51% fewer, and that's why you feel like you can't operate in this marketplace. So as far as the demand is concerned for San Diego County, it's extremely powerful. And like I said, it has everything to do with interest rates being low. And here are interest rates. We have interest rates at like right around 3%. We've had them less than 3%, but this was the reading as of last Thursday. We hit 2.99%. I can guarantee you this, we have next week's reading will be in the threes. So we no longer have interest rates in the twos. And this was what I was actually wishing for, so that we could actually decelerate our market. We're right now going at 120 miles per hour. I'd prefer going 80. It's still speeding. It's still a seller's market. It's just not the rapid, feverish pitch seller's market. And we're not even there. We're still speeding at a 3%. So this is where it's at. We've had 17 record lows since March. So you know what's juicing demand. It's these low interest rates, and it's causing this. This was an agent in Carlsbad that actually took my report and got the seller to list that thing towards its right at its fair market value. Ended up selling $100,000 above the appraised value, and that's what they listed at, what an appraiser came in at, and they ended up getting $100,000 extra by doing that. So you have this many people that that line up to see the houses, and you get this, a bidding war where an auction occurs. And that's what you want. So you have as many offers as you possibly can. And we have to get the word out to homeowners that they're worried about, gosh, there's nothing on the market, so I'm not going to place my home on the market. We have the answer to that. There are two ways we could do this. One of them off the top of my head is ask for rent back of 60 days. I can guarantee this. You write it at the fair market value, your property, you place it on the market at that, and you're going to get 26 offers. And you know, this is a true story of a property in Mission Viejo, $605,000. They had 52 showings, had 26 offers within 2 days, had to place the property on hold, do not show. I saw the Excel spreadsheet because it was my brother-in-law's Excel spreadsheet and his listing, and he actually had that many offers. They were all exceptional. It ended up going for 4% above list price, and the appraisal contingency was removed. And you're going to get people that are going to be willing to pay for your 2 months of rent back. They'll say you can rent back for free. That's how much competition there is right now. Or you can sell your home contingent on finding something. Those are two strategies. There will be more homes coming on the market a month from now. So you should be able to find something within 30 days. Right now, and that's the flavor of the month, and the next couple of months is sold for over asking. We're going to see that continue. And demand, this is that 30-day snapshot of pending sales. And this is what it looks like right now. February 18th, we were at 3,130. It was up 3%, or 97 pending sales in a 2-week period from the start of February to the middle of February. And last year we were at 3,137. Holy cow, it's the same as last year. You are the only county that is doing this. And the only reason why it's happening to you guys is because you literally are not placing enough homes on the market. You're placing 1/5 fewer homes. So when you're missing for sale signs, the market is so feverish that those missing for sale signs would have been shoved right into escrow. So the reason you have the same escrow activity as last year, which was actually really solid escrow activity, the best in Southern California last year, but you're matching it. You could even be exceeding it if we had the proper number of homes coming on the market right now. So today we're at 3,167, and you guys are having a very, very hard time getting off of the ground from where we were at just last week. And that is because not enough homes are coming on the market because it's still winter. And the same thing is happening, 1/5 fewer homeowners coming on. So what happens during the winter market, unlike supply, which remains the same, it doesn't change much. Here's what's going on with demand. It surges. So that's what happens in winter. And that's why the market gets so hot right after Super Bowl, because demand surges and the inventory does not change much. And as you can see, this is typically where we peak for the inventory. And where are we going to go from here? We're going to continue to go up, and for the next couple weeks, until we get to a few weeks, until we get to the middle of March. And then it's going to continue to go up, but just not at the same pace. And it will peak sometime at the end of May. And then with the distractions of everybody being locked in their house from COVID, and the summer distractions of having kids at home and wanting to do more and actually go to the beach this year, that type of thing, we're going to get demand activity going down. This happens every year. People say, yeah, but summer's the best. No, it's in terms of closings. As far as pending sales, new pending sales, the peak happens in the month of May, typically April or May. So we could have more escrows. We could have more sales. The problem is the limited supply is limiting sales. It's limiting demand right now. My demand readings, pending sales. So just understand that that is an underlying part of what's going on in our marketplace, especially in San Diego County. And you can see across the board, pretty much everywhere else is experiencing better demands than last year, except for San Diego County. And so a recap, this is the winter, demand surges, supply is not changing much. Then we're going to get into the spring. That's the second half of March. This is where demand climbs and peaks, and then the supply rises. So that is finally where we're going to get a rise in supply, and then demand will actually peak in the middle of the spring market. Right now, the expected market time, the speed of the market, we're speeding up the 5 freeway or the 805 at 15, it doesn't matter. We are speeding. This is 130 miles per hour. It's too fast for my liking as an economist. It's not what I'm rooting for the longevity of the housing market. We do not want to inflate another asset bubble. And the underlying pillar strength of housing is there. Everybody's had to qualify for everything. The problem is we can't continue to go at this pace. And this is the pace that we're at right now. On February 18th, San Diego County was at 22-day expected market time. It dropped 1 day in a 2-week period. Last year, we were at 44-day expected market time. It was double from where we were, and the hottest market in Southern California even last year. Today, we're at a 21-day expected market time. So it's dropped down 1 day. It just means it's a little bit hotter. Anything below 30 is just crazy, stupid hot. That's how I can best describe it. It's just a manic market when it's this fast. So if I draw a line across and show you where the expected market time is today compared to history, it's the lowest level since tracking in 2012. That is how hot the market is. And we've had an expansionary market since 2012, and this today is the hottest market that we have experienced in that expansion. This is where we're at, and it beats the socks off of 2013, which is in the very left. And as far as the expected market time is concerned, anything below the blue is a hot seller's market. That is 60 days or less. Between 60 and 90-day expected market time, it's actually a slight seller's market where sellers still get to call more of the shots, but we don't have a lot happening in home values. And above black is actually it's a balanced market, and then further up is a buyer's market. We're nowhere close to that. We're well below 30 days, which is really, really hot. And that's where values are appreciating. And it will continue to trend down until we get to the spring market. And then it will start to rise from there. And it'll be even rise further after that as we get more homes that linger on the market a little bit longer, because we will have some overpriced property finally. And as far as North San Diego is concerned, I just picked a whole bunch, and Oceanside's at a 16-day expected market time. Anything in the teens is ridiculous. I just want you to know that. Oceanside's at 16 days. Last year was at 38. Carlsbad's at 26 days. Last year was at 51. Encinitas is at 20 days. Last year was at 58. Rancho Santa Fe's at 83 days. Last year was at 208. That's the other story. Luxury is off the hook right now. San Marcos is at 18 days. Last year was at 32. Vista is at 12 days. Last year was at 38. Fallbrook is at 28 days. Last year was at 71. And Escondido is at 18 days. Last year was at 39. You get the picture. Too hot. That's what this tells me. Anything below 30 is ridiculous. And in the upper ranges, I'm going to tell you 83 is almost too hot for the upper ranges as well. So that's magnificent for luxury. We'll get into that later, but home values are on the rise. They're screaming upwards, and there is no top in sight. So that is what I am talking about. All the fundamental housing economics, everything shows that we're going to be enduring a seller's market for quite some time. It just means that right now we're going 120, 130 miles per hour. We can slow down to 70 or 65 miles per hour, which would be like the speed limit. It still will be a good market. It's just not going to be the crazy market that we're experiencing right now. So the San Diego County market, you can see the different price ranges. The lower the price range, the hotter the market. Below a million, 17-day expected market time. You can see even 1.25 to 1.5 million is below 30 days. It's hot. And luxury in San Diego County is probably the best in all of Southern California. So just know that. So where are rates headed? Well, they've been going down since 1981. So that is a given. They've been slowly but surely going down from 1981 on. 1981, they were a high of over 18%. And then in 1990, they hit 10%. And then in 2000, they hit 8%. And then 2010, we were in the midst of the Great Recession. They just kept on dropping lower and lower, and we got all the way down to the twos. And you can see this is the same thing. This is just like since 1981. And I'm bringing up the 10-year Treasury because you need to follow it. The 10-year Treasury has also been falling since 1981 because there is a stickiness between long-term assets like the 10-year Treasury and the 30-year mortgages follow the same lines that the 10-year Treasury and 30-year Treasury bonds, U.S. Treasury bonds do. So the 10-year Treasury bonds, you used to be able to get over 15% when they were when interest rates were at 18%. Then they got all the way down to below 1% when we went into this pandemic. Then we got interest rates down low into the twos. They should have actually been at 2.25. See, there's this stickiness. There's this spread between the 10-year and 30-year that I was talking about. And here is the spread. The average over time is 1.7. The difference is 1.7. And that is when we have a reading of, let's say, 3%, we should have interest on the 10-year, we should have interest rates at 4.7%. And it's kind of been at 1.7. It varies, but that's the average over time. When we went into this pandemic, it broke and it became much, much larger. And that's because the engine of lending broke. A lot of programs disappeared. The appetite of investors to buy the stuff, as well as people to even work the stuff, it just didn't. It wasn't happening. So it became unhinged. And the spread got really large. But then over the last 6 months, things fixed. And as a matter of fact, it even got tighter. Right now, the spread is 1.5%. That is a real narrow spread, which means anything that happens with the 10-year is going to happen to the 30-year mortgage, which is what happened yesterday. But we'll get into that in a second, because this shows you when we had interest rates at 5%. Remember when we had 5%? So even though we've had interest rates that were higher back in the day, we now can no longer tolerate 5% interest rates. And that's when our market slowed down in November of 2018 when we hit 5%. That's when the 10-year hit a little over 3%. Over here is when we had interest rate, or the 10-year, get below 1%. As a matter of fact, they got so low that we should have had interest rates at 2.25. But remember, I said they got it unhinged. So that is what happened. We had 10-year fall, and then we had interest rates fall like a rock as well. Over the last 6 months, this is when everything fixed itself. But if you look at this towards the right, that little spike is yesterday. We got up to we got above 1.5%. And that was a big jump in one day. And interest rates rose yesterday while I was speaking in a presentation, and we were right at 2.993%. During the day, actually during my presentation, it had risen from 3 to 3.25% while I was presenting in the morning. So that just shows you where interest rates are headed right now. So what will make the 10-year Treasury go up, and ultimately the 30-year mortgage, which is why you should follow the 10-year. All you have to do is Google 10-year, and CNBC's pretty chart comes up, so you can see what's going on with interest rates. So you will know right away how to talk to your buyers as to what's going on a day-to-day basis. But what makes that 10-year go up? Good news, job numbers, good news job numbers, relief bill, vaccine news, good economic reports, like I was talking about retail sales, future stimulus packages. There are things that will make it go down, like a big crash in the stock market or something like that. Those will make the 10-year go down. But overall, the story for 2021 is going to be a rise in the 10-year, which will result in a rise in 30-year mortgages. And I think that once everybody gets vaccinated, and I've heard from so many people, what happens is they just feel giddy. And when they feel giddy, they're going to be ready to do things that they were unable to do during this pandemic, which has lasted now for practically a year. So there's going to be an economic boom, I feel, the second half of 2021. And it's just gauged on what people are saying and what they're already doing and what they're already booking. So I think there's actually going to be a little economic boom. And if you remember the Spanish influenza that happened in 1918, by the time that thing was done, it was 1920. If you remember what followed 1920 was what? The Roaring 20s. So I think a lot of that had to do with these people just being pent up, and then they wanted to go out there and dance and party and all that stuff. So we're going to have the Roaring 20s again coming.
Let's hope flapper outfits don't come back too.
Yeah, I envision it all. I got to have a picture for that, right? I'm going to do that. Flapper outfits. I got to have one. You're right. Definitely. That's a good little transition. I'm going to do that next time. So interest rates are going to be on the rise. Lock it in. Lock it in now. I have a hairstylist that I convinced he needed to purchase. He's been looking. He's lost out so far on 6 offers that he's written. He's been writing an offer a week, and he's going, Stephen, tell me something good. Should I continue to do this, or should I wait for more homes to come on the market? The answer is continue to do it, because the longer you wait, the higher values will be and the higher interest rates will be. So, gosh, I know buyers are crazy. I just talked about my hairstylist, just crazy. They don't know what to do with this marketplace, and they have nothing to blame but low mortgage rates. And I haven't even updated this next slide, so I apologize for it, because, but you can see what's motivated everybody to purchase, because they were at 2.77% 2 weeks ago. And now they're already at 3%. But you can see that the difference between 1 year ago to today for a $700,000 mortgage is an additional $318 in their pocket every single month. That's $3,800 per year in their pocket. That's a pretty fun little vacation, isn't it? And if you compare it to November 2018, when we had 5% interest rates, to where it was at 2.77%, you're saving almost $900 per month, which is 10 grand per year. The savings are still there at 3.25%. It's getting less and less compared to last year. And it's what will ultimately end up cooling things down just a bit. And as far as the home that you're able to afford, at 3.6%, if you're looking for a $3,000 mortgage of principal and interest, no taxes and association, just principal and interest, at 3.6%, where it was a year ago, you're looking at an $825,000 house. At 2.77%, you were looking at a $916,000 house. That is an extra $91,000 in purchase power. And if you compare that to when they were at 5%, you were looking at a $700,000 house versus $916. That's this $217,000 difference. You wonder why people were flooding the marketplace. This is why. And you could see as rates go up, you were looking at $921,000 a couple weeks ago. You're looking at $861,000 house today. So you can see that it's starting to erode home affordability a bit by interest rates going up, which is what I want to see. And you're saying, Stephen, why do you want to see that? Because I want to see more homeowners come on the market, and I want to see demand soften a little bit, so there's not 25 offers, maybe 10. I mean, I'd rather cut that thing down a bit so that values aren't going up as much as they are right now. So that is why I'm rooting for those interest rates. So just understand that. I'm rooting for what everybody else is, long-term health of the housing market, where we sell lots of houses and things are good. That's what I root for. And as far as, here's some market overview things that I wanted to go over really quick. Did you know that juicing demand, this is why we don't need a first-time homebuyer tax credit, because millennials already want to purchase. The prime age for first-time homebuyers is 32 years old, and millennials right now are starting to hit that prime age at a rate that we haven't seen in 26 years since the baby boomers did it last. So this just shows you we haven't been this high in 26 years. Gen X, which is my range, there weren't enough babies in Gen X. So actually we were hitting a muted demographic patch. Now we're starting to get a raised number of people hitting 32, and these people want to purchase, these millennials. So that's an extra added layer of demand coming for the next 4 years. And you can see millennials want to purchase. They asked a question in the third quarter of the pandemic, and 22% of baby boomers see themselves buying in the next 12 months. That's pretty huge. And as far as foreclosures are concerned, there's just going to be no wave. I'm just here to tell you. You can watch my episode from the housing debrief that I'll talk about in a second, but there's not going to be a wave. Instead, there's going to be a slight rise. We're going to look at 2016, 2017 numbers of distressed properties, which if you were looking for distress in 2016 and 2017, there were more than there are today. Yes. However, you were having a hard time finding a distressed property. There was a lot of people that wanted them, just as there will be a lot of buyers that want them when they come online, maybe later this year. But you know what? It's just not going to be enough to satiate the big appetite out there. So they're going to go for a premium. And closed sales for last year were up 4%, or an extra 1,500 closed sales for all of San Diego County compared to 2019. You sold more houses in 2020 than you did in 2019, and we're off to the races already. January of 2021, it was up 7%, or an extra 162. Beat the socks off of the last several years again. So you guys are already selling more houses in the month of January, and it looks like it'll be the same thing for the month of February. So luxury is surging. I told you about this earlier, but if you look on the right-hand side, this is 1.25 million plus. It's the top 10% of the market is 1.25 million. That is in San Diego County. It is a disproportionate number of the closed sales that is occurring right now. And if you don't believe me, here it is. There you go. In 2020, you actually sold 4,256 homes above 1.25 million. It was up 41% over 2019. And it was a record year. You never sold that many luxury sales above 1.25 million. And in January, you were up 29%, or an extra 70 closed sales above 1.25 million for all of San Diego County. And San Diego County is a light county. And if you look at where you guys were at above 300, that was like spring. What you guys used to do in the spring, you did in January, and it continues to look like it's going to be like this for the rest, or for the first half of this year for sure. So how will 2021 play out? Here it is. Frustrated buyers motivated by low rates, they're going to be willing to stretch. This was actually taken from my forecast, which I started doing in September. So that was what I was predicting was going to happen. And sure enough, that is what we're experiencing. Return of the unrealistic overpriced seller. They've always been around, but this year it's going to be really, really bad, especially the second half of this year. Rates rise from 2.75 to 3.5%. I look like almost a fool when I started talking about this. We started off this year at 2.65%. We hit a record low, our 17th record at 2.65% at the beginning of this year. But since then, now we're rising towards 3.25%. And I think by year's end, we'll be at 3.5%. That is my prognostication. And then available homes will be low until the second half of the year. As interest rates go up and more overpriced homeowners come on, we're going to get this buildup in inventory just like we did in 2013. Demand juiced. We will have bidding wars. That is going to be the flavor for the first several months of this year. I've already witnessed it for January and February, and it will be March, April, May even. So total sales up 5 to 10% compared to 2020. And values rise between 6 and 8%. I was saying this back in September, and CAR actually did one forecast and they revised it. They just revised it again last week, and now they're in line with what I was talking about in September, that we're going to see some really solid appreciation, probably in the realm of about 8% in San Diego. And distress rises, but no wave. We talked about that. Luxury thrives in the spring and summer, then downshifts. The peak for luxury is the same peak for the rest of the housing market, and that is the month of May. We get the most activity in the month of May. So when do you want to come on? If you're luxury, for Pete's sake, place it on the market in April or May. That's when more people go into escrow. So do it then. Don't come on the market in July, because that's a recipe for you finally get it at the right price in August, and then you're going to sit until 2022. So normal housing cycle, that's what's going to happen. That is, spring is the best in terms of pending sales. Summer is second in terms of pending sales, not closed sales. Autumn is third, and winter is fourth, and the holidays. And so go to reportsonhousing.com, click on subscribe. It's $15 per month or $150 per year. You get a month free if you utilize the coupon code NORTHSD. And I do have sample reports at Reports on Housing, so go there. Housing debrief, I've alluded to this. It's today at 3 p.m. I'm actually going to talk about rising rates and its implications and impact on housing. It's from my personal page, SoCal Steven. You do not have to be my personal friend in order to watch it. I'll broadcast that out to the public. I do have a business page, Reports on Housing. I will house the broadcast there afterwards. The algorithms are better when I do it on my personal page. I will be broadcasting it live from YouTube as well. You can see all my old reports also. You can see the one on there will be no wave of foreclosures that I did last week on YouTube. And I can open it up to Q&A now. I've stopped the sharing. So are there any questions that are in the Q&A I see? Will this be recorded? Yes, it will. Please talk about housing only. I love that. So people get upset that I talk about anything that has to do with COVID. I get it. However, I'm an economist, and I have to tell you the implications and how it's working. That once we're thawing out of, it's part of the good news chain is happening to interest rates. That's why I include it at the beginning of the report. So I get that.
Stephen, I have a question.
Yeah.
You mentioned in kind of the beginning that you thought jobs were going to come back faster than had been sort of forecast by the government talking heads. Why do you feel that?
Oh, that they're going to be coming back faster?
Yes.
Just because intuitively, I know I kind of know what the beat is. I think sometimes these people, they get stuck, locked up in looking at just numbers rather than listening to the people. I'm all about listening to people, which is why I'm able to talk about housing the way that I'm able to talk about housing. It pretty much, I represented buyers and sellers and dealt with them, dealt with other agents, dealt with everybody. I am a broker myself, so I understand that. So getting in front of the people is what tells you more about what people are going to do. And talking to people that have the vaccine already in their arms, there is a little bit of exuberance that I think that people aren't anticipating. It's that flapper mentality that we just talked about. I think everybody's ready to put on their flapper and go out there and dance, right?
Yeah, I definitely think a lot of people are ready to dance.
So I think that's what we're gonna see, and I think it's gonna manifest itself to a little bit quicker of a rise in jobs than we're anticipating, which will mean higher interest rates.
Yeah, definitely. You also mentioned that the 10-year is affected by Wall Street, and did you see Wall Street this morning?
Yes, it's
So what do you?
yesterday. Where is it at right now? I saw it first thing this morning.
Oh, it's dropping like a stone. Everything's red. I think they may be suspending trading.
Well, the reason it's dropping like a stone is because they love these low interest rates. But the problem is we can't have an overheating of the economy, which is what I'm already talking about. So when you have an overheating of the economy and you have low interest rates, that will fuel inflation that we haven't had. It's not the fact that we're spending money that's causing it. On top of this juiced economy, what's coming? People are going to get more money in their bank accounts because we're passing this next package, and this next package is going to get us to the other side of the vaccine. But it's almost, gosh, you gotta couch it with, it's going to come with more economic activity and higher rates. So they're starting to realize that, and people are changing their positions in equities because we're going to be coming out of this sooner than what they were anticipating.
Okay, good. Well, I mean, it's definitely, the stock market is legalized gambling. It goes up, it goes down. So I like to see that, but I was just curious about that connection with the 10-year and how rapid it responds, and whether or not it's caused by or responding to. But I think you did answer that earlier. And then the only other question I had was, why do you think, other than it's just a function of price, that Southern California, San Diego in particular, has such a high level of the high end? I mean, you would think it would be more like, LA or even San Francisco.
Well, actually, LA is the one that's hurting the most, and they're doing the best. Everybody's doing well. Luxury is outperforming every other price range in all of the markets. So that's 800,000 plus in Riverside, 650,000 plus in San Bernardino. It's 1.25 for San Diego. It's 1.5 million plus for San Diego, and for Los Angeles and Orange County. Now, LA is the slowest of all five. San Bernardino, Riverside are off the chain, and that's because it's inexpensive, right? Not San Diego, it's Riverside and San Bernardino. San Diego is along the coast, the cheapest of the 3 counties. So LA, what they're doing is they're migrating down to Orange County, but they're also, there's a lot of people that are looking at all along the coast, Orange County and San Diego County. And there's a little bit
Yeah,
of
we see them actually. We see that they're looking there and here, and we work with them in both places. It's kind of interesting.
Yeah, but you get more bang for your buck in San Diego County right
Yeah,
now.
definitely.
And you used to get that in Orange County as well, but now enough of LA people have come down to Orange County and bid everything up, and that's now what's happening in San Diego County. So, and I understand that UTC is turning into a little tech area. That's this next tech area. So that's bringing a lot of wealthy, uber wealthy people too. So I heard
It's been that a while. It's med tech. It has been in that whole area down through Sorrento Valley and UTC. That's all med tech. And that's been that way for, gosh, probably 15, 20 years, but it's just now sort of exploding out.
Yeah, and there are companies that are relocating down to San Diego County because of the fact that they can buy such a big mansion compared to where they were.
Affordability.
Silicon Valley or LA. So I heard of a property that was listed at $22 million and actually had 7 offers. So
cash, right? Just have it laying around in the couch.
Bidding war.
We actually had a question in the Q&A, and this is from an agent who actually was originally worked in the Silicon Valley area. Lenore, I don't know if you can unmute yourself, or if you want me to read it, I'm happy to. I don't know if she can unmute.
She cannot do that, but
okay, then I'll read it. She had the question. She said the parallels to Silicon Valley's real estate market in the early 2000s is remarkable. Multiple offers didn't stop and are still happening. Prices have kept going up and up and up. Will this be our future?
It really depends upon where mortgage rates are at. And right now mortgage rates are too low, like I said. So there will be demand for quite some time for all of Southern California. We'll be seeing sellers market, and in San Diego, we'll see this continued rise, that kind of like what we were experiencing in the Bay Area. There's a lot of room for growth based upon what happened in the Bay Area, but that's going to take time to get there. And the higher rates get, which is the direction that we're headed, there are enough people that are going to take a little time off from searching, or might stop searching altogether because it's no longer as favorable as what it was, say, a month ago. So we'll see a little bit more of that. So that will slow things down a bit. So, but
isn't it also fueled up there by the crazy salaries from the tech? You know, you had such big companies, and you get people, you know, that have crazy salaries and still can't afford a house.
Yeah, and there's only so many properties in the actual Bay Area, period.
Yeah.
So it's very locked in. So, and if you wanted to be in San Francisco, you really are going to pay a premium for it because there's only so many houses that are to have. The fortunate part about San Diego and Orange County is our beautiful coastline stretched for a very long period of time. I know of many, many great cities that it's not just that La Jolla that everybody knows about internationally. There are great properties all along the coast, period. I lived in Carlsbad for a while. I lived in, Cardiff by the Sea. These are great places.
And you wish you still owned that house. The Carlsbad one in particular, we could sell it 17 times over.
Yeah, I was going to school at UCSD. I probably should have bought one, but I couldn't afford one on Cardiff by the Sea. We could rent. But I see that there's going to be legs for this for quite some time. It's just that we can't sustain the current momentum, period. No one can. It's too brisk of a pace following from 2000. Remember, we increased from 2012 all the way through 2020. We can't continue to go at this pace. It's just too brisk of a pace. We've already come way up in value. We can't continue to go that direction.
We are technically out of time, but I wanted to, there was one other question. And since you brought up your renting while you were going to school, what do you think, what effect will the question is rental evictions, what will that affect the small property owners? And I think that means the moratorium on rental evictions, and when that eventually gets lifted, how that will affect the market.
Yeah, there are actual ways out of this. California will pay they will pay 80% of everything that's owed if they go ahead and waive the additional 20% and not evict. So, and work with their tenant. So, I mean, there are programs that are out there. So there will be enough different stepping stones that will make it so it's not this wave, this big giant crash. So we've learned quite a bit from the Great Recession to offset this. Also, there's going to be people that are going to be pulling out of the marketplace as interest rates rise, and there will be more rental demand when that happens. There's plenty of rental demand that's currently out there. It's not as at the feverish pitch that the rest of the markets there that is experiencing, but it still is pretty good. It's pretty decent. It's not as bad as what people are projecting, and things will get better as we get more of these industries that will be opening up, so that these guys can be made whole, and then at least they get 80% of what has been owed them.
Thank you so much. I seriously could sit here and listen to you talk all day and ask you questions all day, but we are kind of out of time. And I just wanted to thank you for such an informative, just amazing presentation. I so appreciate that. And your amount of information in such a short amount of time is fantastic. I talk fast too, so I relate. And I really appreciated your time and your expertise today.
I appreciate it. So everybody, if you want to subscribe, it's reportsonhousing.com, and North SD will get you a free month.
That's awesome. Take advantage of that, everybody. It's well worth the time, and it makes you look like a genius to your clients.
Thank you very much. I appreciate you having me. Have a beautiful weekend. See you at the housing debrief. Stay tuned for that later on today.
Yes, that's a great idea. Thank you.
Thanks much.